Cash flow and profit are two numbers that small business owners need to have a really good handle on when it comes to reading their reports, especially because the difference between the two does have a pretty significant impact on your possible tax liability. So, what is the difference between cash flow and profit? Well, cash flow is a running total of all of the ins and outs that occur through the course of running your business. And it generally most closely resembles the cash that you have in the bank or your checking account balance at any given time. However, profit is a little bit different. Profit is your gross income, your top line income, less your cost of goods sold, less all of your operating expenses to arrive at your net income number. Let's go ahead and dive into a couple of examples of how these two numbers can diverge and be a little bit different given some different parameters. To demonstrate this point, I'm going to use one of my all-time favorite examples, which is the rental real estate industry as a whole. So let's say that you own a rental property, which you rent out for $5,000 a month. That's great, that's money coming in. But we now have to account for all of the outflows. Let's say that your mortgage is $3,500 a month. So $3,000 of that is going towards the principal that you owe against the mortgage, and $500 of that is interest. Then on top of that, let's say that we have property taxes of $750, and then utilities or repairs and maintenance of $275, and finally management fees totaling $250. If we take the $5,000 and subtract out all of those expenses, we're going to be left with a positive cash flow of $225 a month on that rental property. That's absolutely wonderful. And if you're looking for a reason to purchase a rental property, that could be a really great argument. But let's go ahead and break down what the profit and loss on that rental property would look like and why it matters. Let's take all the same numbers from that previous example and use them to calculate our profit on running this rental property. Now, we still have $5,000 of rents coming in. That's wonderful. That does not change. But from there are some changes that we have to address. So, property taxes, repairs and maintenance or utilities, property management fees, those are all still deductible expenses when we're looking at our profit and loss. But the way that our mortgage is treated is a little bit different when we're looking at profit versus when we are looking at cash flow. For profit, we only get to deduct the interest portion of our mortgage payment. So that means instead of deducting $3,500, we're only going to get to deduct $500. So again, let's say we have $5,000 of rents coming in, less the $500 of interest that we pay on the mortgage, less the $750 in property taxes, less the $275 for repairs and maintenance, and less the $250 for management fees. That gives us a profit of $3,225, which is a far cry from our positive cash flow number of $225. And here's the kicker, and where people can sometimes get in a little bit of hot water. Your tax liability is based on your profit, not on your cash flow. So I know I just walked through how this particular phenomenon impacts the rental real estate industry. And you might be thinking, this doesn't actually impact my small business at all. And that could very well be true. If you run your business without loans of any kind, if you've never taken out a vehicle loan or an equipment loan, or if you've never taken out something to purchase a building, maybe you don't have any liabilities that you're paying back over time. But if you do have any of those concerns, you are going to be seeing a difference between your profit and your cash flow. Additionally, depending on your business structure, any money that you, the business owner, take out of the business may or may not be deductible to your company. If you're paying yourself wages as an employee of the business, that is of course deductible. But any distributions that you take that aren't paying you back for investments that you made in the business, those are generally not deductible to the business and are taxable. As a general rule of thumb, if you do not declare the cash as income when it comes into your business, you do not get to declare it as an expense when it goes out. So let's talk about a few different examples where this might be true. Let's say that you get a loan from the SBA to fund your small business and help you get it off the ground. Well, when that money comes into your bank account, you don't declare that money as income. It's a deposit into your bank account, and you record a liability onto your balance sheet showing that you still owe that money to the SBA. Then, as you reduce that liability balance, as you pay back that loan, you do not declare that money as an expense. It instead goes to the balance sheet where it reduces that liability. Like I said, though, the interest does still get to stay on your profit and loss, where you do get to declare it as an expense. This is similar to how it works if you take out a loan to purchase equipment or a building for your business. Usually in that instance, you're not ever going to see the money is never going to come into your account, but that money goes to somebody in exchange for a fixed asset type item. And when that happens, you record the fact that a fixed asset was purchased, which shows up in the asset section of your balance sheet, and you also record the liability, and that shows what you still owe on that asset before it is 100% yours. And as you pay that back, you decrease the liability section every time you make a payment by whatever amount should be applied to the principal on that loan, and you get to declare the interest as an expense on your profit and loss. This is one of the biggest reasons that CPAs and bookkeepers are going to be asking you for loan statements if you have any active or outstanding loans on your books. They want to make sure that you are getting the benefit of deducting that interest on your profit and loss, and that your loans and your loan balances are all correct on your balance sheet, so that there is no reason to look into that further if you're ever audited for any reason. I hope I've answered some of your questions surrounding profit and cash flow today, and if you have any further questions, please do let me know in the comments. I'd be happy to help, and I definitely will get to answering as many questions as I can. If you found this useful, please do like and subscribe. I'm Holly, I'm the owner of Accrual Mistress Bookkeeping and Consulting, and thank you so much for watching.